What do mining resource companies do?
They do exactly what they say on the tin. They dig the stuff out of the ground and sell it. That's a simplistic answer. A mining company it is a broad term, and it tends to cover a whole lot of companies at different stages of development. I tend to differentiate between mining companies and exploration companies. The reality is resources are largely, most of them, scarce, and finding them becomes increasingly more difficult. So you need geoscientists to go out and find them and look for them. But the rate of return, or how I think about it, the number of times they actually find an economic deposit is actually very few and far between. It's kind of like you got to kiss a lot of frogs. They turn over a lot of rocks to find what's known as an economic deposit. But once they've gone out and used lots of geoscientific tools to find a deposit that looks large enough to be and high quality enough or grade enough to be economic to extract from the ground, then the mining companies come in, or the miner or an exploration company often either gets bought or turns into a mining company. And at that point in time, they finance a lot of studies to figure out the most economic way to extract those minerals, and then they build it, which takes 2 or 3 years to build the facility. That is, on one part, how to economically dig it out of the ground in the most economic manner. And remember, they're moving millions of tons of rock. Moving that rock efficiently is quite difficult. And then they have to process it. So they have to crush. The first step would be crushing the rock to small enough particles, and then find some way of chemically processing the metals out of it.
And for that very reason, mining is very cyclical, isn't it?
That plays into the cyclicality. So when you go out there, you find new deposits, which takes time, and then you develop the new mines, which take time, and more than time, they take money, lots and lots of money. And then they take infrastructure as well, and that has to be built to service the mine. So when metal prices are low, you have no real incentive to go out and find new mines. And if you don't find new mines and don't find new metal, then you tend to find then slowly over time you get shortages. In that period of shortage, the price tends to spike because you have a demand supply. They don't match. And good old-fashioned economics, supply moves down and therefore price goes up. Suddenly the price is up and the miners have incentive to go out and find new mines. But that time period, that time lag, is the issue. So they go out, they find new mineral, whatever mineral's gone high, and then it takes 2 or 3 years at least after they've found it, which can take 2 or 3 years, to permit it, build it, and start actually producing metal. That time lag, the price goes up, and everybody and their brother is out there looking for new metal. Then suddenly all this new supply comes onto the market because of those inefficiencies in the finding and developing and producing. And suddenly there's an oversupply and the price crashes. And that is the mining market in a nutshell.